Hello and welcome to my channel. Today we're going to look at shorting stocks. When you short a stock, you are betting on the price of the security to fall. When it falls, you make money. We're going to look at the mechanics behind it, how it works. We're also going to visit Jim Chanos in a few video clips. He talks about two of his current short positions. Short sellers play an important role in markets. They make markets more efficient. So they go look for companies that are committing fraud, deceiving the public, lying to the public, manipulating their books, their earnings to please Wall Street. Enron in 2000, they were doing just that. They were committing fraud and lying to the public. Chanos was on to him. He shorted the company. In 2001, Enron filed for bankruptcy. Chanos made millions. Lehman Brothers in 2008, they were overvaluing mortgage-backed securities on their books. David Einhorn, he was on it. He shorted a company. September 2008, Lehman Brothers files for bankruptcy. David Einhorn made millions. Short sellers will go in and short companies where their price has been bid up for no reason. They think it's going to fall. They'll go in and short a company. They also look for companies that aren't changing quick enough. Their business model's outdated. They haven't changed and they're getting eat up by the competition. They will go in and short the company. Research in Motion, who made the BlackBerry back in 2011. Everybody was buying Apple iPhones and Samsung phones. Research in Motion didn't change quick enough. They were eaten up by the competition. Their stock collapsed in 2011. Eventually, they left the cell phone business altogether. So let's go visit these video clips of Chanos where he talks about his two short positions.
EV, certainly, the market leader in that. And then I think we talked about big cap tech. Having said that, I think that it's really a business model and a valuation issue with Tesla. I mean, there's some things we don't like about their accounting as well. But I mean, this is a company trading at $500 billion market cap. It'll have revenues this year of $30 billion. And despite what everyone says, they're still an automobile company. They make cars. And so they're competing with other companies that make cars. And increasingly, those other companies have EVs as well. And so, you know, Tesla, every bull market has a stock that people pin their hopes and dreams on. You know, back in the dot-com era, it was Cisco and Yahoo and a few others, JDSU, and certainly one of those stocks this go around is Tesla, because for some holders it's an EV company, for other holders it's a clean energy company, for other holders it's an autonomous vehicle company, and it's whatever people want to believe that Elon Musk is touting. And that the traditional rules of valuation do not apply to it. I would just point out, as I always do, that for the trailing 12 months, Tesla has not made any money selling cars. The trailing 12 months, whatever profit they've shown, it's been very, very low, has been from selling tax credits.
Okay, so Jim Chanos thinks there is something wrong with their accounting. He also thinks that Tesla is just an automobile maker and they don't make any money. They only make money selling emissions to other automobile companies or emission credits. So he is short the company. Let's go look at another one of his shorts, IBM.
There's different opportunities. One, I think, is probably one of my highest conviction ideas, is an idea that I think will surprise the viewers. It's a company that nobody's heard of called IBM, and it's a value trap. And we've had a lot of success down through the years in companies that actually have looked cheap, but have had really structural, fundamental problems. You know, stories like Exxon and others. And so IBM to us not only is one of those situations, the business is still shrinking, but it's also an accounting story. And I think that's what is so fascinating about IBM, in that the company, we think, is still engaging in basically accounting hijinks. And it's hiding all in plain sight if you take a look at their numbers. I mean, IBM is supposed to earn $9 pro forma this year. The real number is basically $6. If you look at IBM's operating earnings, very simple for your viewers to do. Just look at IBM's operating earnings plus their intellectual property royalties, subtract out net interest, and tax it at 21% at the statutory corporate rate. And you get to about $6 in 2020 in earnings. IBM's going to report 9. Next year, we think the number is going to be $5, Scarlett, and the IBM estimate is close to 12 on my Bloomberg terminal. And in 2022, we think the number is going to be closer to $4, and the Bloomberg estimate is close to 13. And how they're going to turn $4 into 13 over the next 2 years is beyond me with revenue shrinking. And so IBM increasingly has engaged in lots of games to do this. And the latest one is they're going to do a spin-off and now take a lot of charges that they're going to ask you to add back as part of the adjusted earnings so that the actual GAAP earnings don't look so bad. But they can only do this for so long. I mean, IBM tried to do this about 5 years ago when they told everyone, and you might remember this, they were always going to earn $20 per share in the out year, and the stock traded around $200. And after about 2015, 2016, they had to reset expectations and really tell the world, well, we're really only earning closer to $10 or $12. And the stock sold off from 200 to 120, which is where it is today. And it's basically been flat since then. But now I think we're looking at the next reset, where they're going to have to tell you that we're not really earning 9, 12, or 13. We're actually earning 6, 5, and 4. And that's going to be the next reset. And I think that that's probably coming over the next couple of years with the stock at $120.
Yeah, I really don't know what IBM does. 30 years ago, they used to make computers. They got out of that. I kind of think IBM is one of those companies that is getting eaten up by the competition. They're in cloud storage, consulting, but I just don't think they can compete anymore. Jim Chanos points out they are manipulating their earnings, and revenues are declining. So after watching this video, I think I'm going to take a short position on IBM. Let's go to the mechanics on how short selling works. I want to visit that. I got a little simple diagram I'm going to walk everybody through. Okay, here's my diagram on shorting stocks. Let's ignore this. We'll come back to this. Ignore all this stuff. We will come back to that. So Schwab's my broker. I work a lot with Schwab. So do a lot of other people. So I want to sell, or I want to sell short a stock. I want to sell short Apple because I think it's overvalued. So Schwab has a lot of clients that hold on to Apple stock. So they have a huge inventory of Apple stock that they have access to, because when you create or open up a brokerage account with Schwab, you're giving Schwab permission to loan out those shares that you buy. So Schwab investors that have an account with Schwab that own Apple stock have given Schwab, when they open up a brokerage account, Schwab permission to loan those shares out. So that's step one. I want to short Apple. I want to short 1,000 shares. I go and borrow 1,000 shares from one of Schwab's customers. Sell it straight at 130. 1,000 shares at 130 is $130,000. I get $130,000. Not really. They don't give you the money until you close out the transaction. They put it into a separate holding account. So if Apple falls to 120, I just made money. I go back to the market through Schwab, since Schwab is my broker, and I buy 1,000 shares at 120. So I actually sold it first. That's what you're doing when you're shorting stocks. You are borrowing shares from existing clients, shorting it 130, buying it back at 120. So we sell first at 130, buy it back at 120. I just made $10,000, and I have returned those shares back to Schwab's clients. So that's pretty much how it works when it comes to shorting. You are borrowing from existing clients within your brokerage account. And mine being Schwab. Schwab is a large brokerage account. They have access to many securities that I can borrow and go to the market and sell short. So what if Schwab doesn't have any securities for me to borrow? Last May or June, when Hertz in bankruptcy court got permission to sell additional shares to investors to help finance the bankruptcy, their stock popped to $5 a share. I wanted to short Hertz. I went to Schwab and tried to short Hertz at the time because when they exit bankruptcy, when Hertz comes out of bankruptcy, all the existing shares are going to expire. That's typically what happens when a company files bankruptcy. When they come out of bankruptcy, existing shares expire and they start new. So I wanted to short Hertz. It popped to 5. I know they're going to 0. I wanted to short it. I went to Schwab. They didn't have any shares available. So they sent me to a securities lending specialist who can get those shares for me. And typically you have other companies like M1 Finance that will lend shares to securities lending specialists, and they make money doing that. They lend out shares, Robinhood, T. Rowe Price. Just using these guys as an example, they will lend their shares out and make them available to people like Schwab. But when I tried to short Hertz, the price became really, really expensive to short it because these guys will charge a lot of money for loaning shares out. That's what they do. So when I called these people, securities lending specialists through Schwab, they wanted to charge me, for example, if I shorted $100,000 worth of Hertz, they basically wanted to charge me 100% annually to hold that transaction. So if I held it for a year, shorted $100,000, it would have cost me $100,000. Not knowing when Hertz is coming out of bankruptcy court, I really couldn't afford that. So I couldn't short the stock. Just wasn't available. So that's what happens when they're not available. Schwab will send you to a specialist who specializes in lending securities. But depending on the demand to borrow those securities, the interest rates or the fees they charge can be astronomical. A couple other things I want to point out. I have 4 stocks down here on the bottom and some statistics that go along with it. First one is Bed Bath & Beyond, BBBY. So they have 1 billion shares outstanding. Their short interest. So when we look at short interest, their short interest is almost 70%. That means of those 1 billion shares outstanding, 700 million of those are short. That is a lot of shares to be short. That means a lot of investors are shorting the stock and betting BBBY will go bankrupt at some point in the future. So I couldn't short this stock. It would cost too much. More than likely, Schwab doesn't have any shares available. They would send me to the securities lending specialist who would try to find those shares and charge me a large fee. And because this short interest is so high, almost at 70%, that fee would be high. Let's look at Apple Computer. So Apple Computer has 17 billion shares outstanding. Roughly 0.5% of those, 0.54%, are short, meaning only 90 million. So when I go to short Apple, my broker more than likely will have enough shares in inventory that they can loan me those shares, and I won't have to go to a securities lending specialist to borrow it. So it won't cost me an astronomical amount of money to borrow or to short Apple stock. Third company, W, or Wayfair. So I tried to short Wayfair last week at 340 when it hit 340 shares last week or the week before. I couldn't do it. There is a large amount of short interest. So if we look at Wayfair shares, there's 100 million outstanding. 20% of those are short, or almost 20%. That is a large amount again. So when I went to my broker did not have any available. When I went to securities lending specialists, they did not have any available for me at that time. So I could not short Wayfair. I could not borrow the shares. They just weren't available. I don't know why. Short interest is 18.92%. So a lot of people are short. Last company is IBM. Like I said earlier, at some point in the next few weeks or few months, I'm going to take a short position in IBM because IBM is a dead walking company. So IBM pays a dividend, $6.52 a share. That means if I short 1,000 shares of IBM and I hold on to those for 1 year, if I have that position open for a year, I have to pay that dividend. So I borrowed those shares from somebody through my broker Schwab. I borrowed them. I have to pay them the dividend if I am short those shares on X dividend date. So shorting 1,000 shares every year I will have to pay $6,520 in dividends to somebody. It's the only bad thing about shorting is you have to pay the dividend. So I would have to do that. That's going to cost me. But if IBM falls 50 points in a couple years, short 1,000 shares, and I just made $50,000 minus the dividends that I had to pay. Okay, that's it for shorting. So if you like the content, hit the subscribe button, hit the like button, and we will talk again soon.